Hi, everyone. This is Jason Burack of Wall Street for Main Street and independent financial analyst and managing editor of the News Doctors, Eric Dubin. Welcome back to another Welcome to Dystopia podcast. This is episode number 7. In today's podcast, we're going to talk about volatility in the markets and how there's enormous amounts of intervention and manipulation and massaging of markets by so many different governments nowadays. Basically, all the major economies, all the major countries in the world are all trying to manipulate and intervene in markets. Eric, is this what you see now with the stock market and so many other things?
Well, sure. I mean, there was a story a couple of years back where it was disclosed that central banks all around the world are dumping, trillions of dollars and managing their respective financial markets. And, the level that interest rates fell about 2 years ago at the bottom were 400-year lows for interest rates across the board in Western economies. I mean, if you don't call that an order of magnitude more manipulation, then I don't know what is manipulation. I mean, the central bankers now are buying directly assets and monetizing debt. The Bank of Japan in many periods in any given month, or maybe many a month, when you look at the last 2 years where the Bank of Japan has literally purchased 100% of the issuance of Japanese bonds. I mean, that's just insane.
Japan's further down the road. They're closer to endgame, right? I don't think anyone will dispute that in terms of the math problem that they have. The perverse thing about it is Japan needs to sell more and more bonds at lower and lower yield, and there's really not any more demand for those bonds, so it makes sense that their central bank is going to step in and postpone a collapse and keep kicking it down the road as long as they can. I've thought about this for a long time. The only way I think that they can buy up all those bonds is to just keep printing more of their own currency. I don't see any other way that they can find any capital to get to buy those bonds.
Yeah, and you would hope that if in a hypothetical world and in a following hypothetical argument, if the U.S. Fed was purchasing all of the bond issuance, that people would look around and say, well, gee, maybe there's a problem with this and we can't continue this. But they can get away with it in Japan because the yen is not a reserve currency. It's only a relatively small percentage in terms of, the reserves held by other central banks, and in terms of a trade currency as well. It's not as pervasive as the dollar, so they can do this nonsense. I mean, even last week, in this 2.5-week period where we've moved through and had a really sizable correction, the S&P 500, there was a heck of a lot of volatility, and China was rolling over and doing all kinds of gymnastics. The Federal Reserve came out and did reverse repos of 24-some-odd billion last week to stabilize the markets, and that's all above-board information. They make that public. But underneath the surface, what looks like may have happened was that the Bank of Japan and Fed did a giant currency swap, and midway through last week, we all of a sudden saw FX footprints of what looks like the Japanese bank coming to the assistance of the Federal Reserve and taking this swap back up and give the mechanics of it. The Fed would print up digital currency, say 20 billion, 50 billion, whatever the number would be. They call up the counterparts in the Bank of Japan. They do the same in yen in terms of the dollar value equivalent. They swap those assets. It can be underneath the surface for a period of time without needing to be reported, because that is, in fact, a law. And all of a sudden, Japan decides to bring that accounting balance sheet adjustment and their Bank of Japan balance sheet into the real world of the financial markets by taking the yen equivalent that they printed to match up, and working with the Fed and the New York trading desk as well, purchasing dollars to purchase S&P 500 futures and other assets to save the stock market. I think that's what happened last week, in addition to the reverse repo. And that speaks to what we started out this podcast about, with this insane volatility being addressed by insane levels of manipulation that never fix the underlying problems, that only set up the next stage for further insane volatility. It's like this flywheel that we're stuck on. And
it's a feedback loop, yeah.
Exactly. It's a negative feedback loop. I mean, I recall when Nominees talked about how she was invited to speak at the New York Fed branch offices. And after her presentation and after talking to people privately, she basically came to the conclusion that the central bankers setting policy in the Federal Reserve are just flying by the seat of their pants and experimenting, and many of them are actually willing to even disclose that fact in private. They won't say it in the media, but that's what people were telling Nominees. and she's a very trustworthy reporter and objective voice, and I think that her recounting what happened when she visited the poobahs behind the scenes in the Fed is true. We have a policy establishment where these Keynesian bankers are flying by the seat of their pants, and that also contributes to this level of volatility.
When you have a hammer, everything looks like a nail. When they don't know how to deal with the problem, they go back to their basic programming. They revert back to, you know what, we just got to provide more liquidity in the markets or things like that. The volatility, this is not something that came out of the blue. We hadn't had a lot of volatility other than in commodity prices for a very long time. Also, there was volatility in currency prices, but there wasn't a lot of volatility in a lot of the major U.S. markets for a long time. In episode number 2 of Welcome to Dystopia, about SHTF scenario,
right,
we talked about how fragile markets were and how, we hadn't had a lot of volatility in American markets and how we could see that come back with a vengeance in the near future. So it looks like we're starting to see volatility come back to these fragile markets. I did a video last week about the stock market and the technicals, and the technicals on the major stock market indices year to date in the last 6 months, they are very bearish on high volume. So that means the downtrend is starting to be established. And then the question is then, how much time and effort and money is the Plunge Protection Team, the Federal Reserve, the Working Group on Financial Markets, the Exchange Stabilization Fund, all these different potential groups, how much money and time are they going to have to put in to reverse this downtrend that the free market is trying to say, you know what, the stock valuation should never have been this high in the first place, and we need a large correction / crash coming up to start to correct this imbalances.
You and I have talked about this over the course of the last few days, and my belief is that the Fed, just like we saw last week, this isn't necessarily me just pulling something out of thin air. The behavior that they demonstrated last week speaks to the fact that they'll move hell and high water to install a crash. We were heading towards crash territory. 1,000 point plus moves in the Dow on an intraday basis for last Monday speaks to the degree to which the confidence underlying the market was evaporating, and it only turned around when the Chinese authorities said that they were going to more aggressively support the market, and the Japanese and the Fed probably did what I described a moment ago about the currency swap, and then the direct repo operations. So the missing ingredient that we have yet to see in the markets is the conventional finance world coming to this kind of punctuated evolution point of losing confidence in the thesis that the Federal Reserve and the other central banks have their backs. We still have that as a prevailing psychology that's governing the way in which these people who are largely on autopilot, they don't read Zero Hedge, they don't listen to podcasts that we produce, they're not exposed to the level by which information can make them want to honestly second-guess their assumptions and be more proactive in terms of risk management and professional when it comes to looking out at the real world and being objective. They literally believe all the economic reports about the job numbers and the inflation rate being at 5 and change percent. Excuse me, I misspoke. The justification for unemployment being at 5 and change percent. They believe that thesis, and they believe that the inflation rate is under 1.5% consistently for the last 3 years, on and on and on. They literally believe this stuff. And I think that there's going to be a kind of evolutionary strain of the markets underneath that erodes confidence over time to the point where, and in particular, it'll go into hyperdrive if we do have a big enough correction that justifies or gives the freedom of the Fed to act for QE4. And then sometime in 2016, if we get that QE4, it's not necessarily a foregone conclusion, but if we get it, at some point, I think people in the Western world are going to look around and say that this Japan buying 100% of the issuance and the Federal Reserve now aggressively embracing QE yet again, that we're going to have some kind of a break in confidence and expectations about the Fed having everyone's back and the bond vigilantes returning, and 200, 300 basis points is added to the 10-year note in the United States. And that's the kind of thing that could conceivably bring a much larger bear market cycle underway. This volatility frequently is the kind of thing that you'd expect to see as a prequel to, or an advanced signal to that kind of shift in markets. The S&P 500 since March 2009 was going up at a 45-degree angle for 5 years, and then only in the last year or so began to level out. We went through some perturbations in summer of 2014 and leading into October, but it really was only until this year that we started going horizontal. And here we are now with this rollover that's happened in the last month and busting of the 200-day moving average in the S&P 500 and on and on.
Those are fundamentals and technicals on charts, which are normally in the past how investing works. But I think since 2008, the rules have changed, at least after Lehman Brothers was allowed to fail or sacrifice as a sacrificial lamb. We had other instances in time where government stepped in, but I don't know if they were as actively in every single market. But now, Eric, it seems like so many of the major governments are involved in markets, whether it's China trying to stop their market from crashing or Japan in buying both stocks and bonds. They're buying ETFs as well. We got Europe manipulating their interest rates. We got the United States heavily involved in so many of its major markets. We have Saudi Arabia and OPEC actively trying to manipulate the oil price lower. There's a lot of articles you showed me over the last couple weeks where their Saudi oil ministers speaking in Middle Eastern papers talking about how they wanted to knock the oil price down and they're willing to take a lot of pain in the short term for a long-term gain and more market share, and they think the oil price will go back up in a couple of years and they'll make all their money back.
Yeah.
There's just so much government intervention, and this is, I think, important to interviewing over 300 experts on many different topics on our channel of Wall Street for Main Street, and me reading so many different topics and sources and speaking to so many experts like yourself. This goes back to my 3 rules, which are, I think, the most important rules of investing in this new normal. And the main rule is, rule number 1, and, this is just from seeing this after in a post-2008 world, politicians and governments can and will change the rules anytime they want, perhaps on a daily basis going forward, moving the goalposts, retroactive rules, moving the targets, changing the economic data with new formulas and equations. I live right outside D.C., and I know how many lawyers are here. I think we have the highest amount of lawyers per capita of we have lawyers in basically every single government agency, lawyers running things that are not supposed to be running things in certain government agencies. They're not experts in their field, and yet the lawyers are the ones making a lot of the key decisions. So the powers that be, the economic elites, Eric, either they are lawyers themselves, maybe they have a couple degrees and one of their degrees is a law degree, or they have the money in place where they can afford to buy the best lawyers to change the rules. Throughout history, politicians have always tried to lie, cheat, and steal and change the rules to benefit them. But towards the end of empires, it seems that just becomes fully dystopian, fully perverse on the levels that gets like people are like, oh my God, the corruption is just rampant. Whether it's the Chinese Empire or Mongolian Empire or British Empire or Roman Empire, towards the end of these things, the amount of corruption and rule changing, graft, and everyone just trying to steal stuff is just insane.
That is directly in relation to the end stage of an empire and its devolution. We are definitely experiencing that in the United States, and for the most part, very few people recognize it.
I agree. Or people might recognize it in their one industry or the one issue that they pay attention to, but they don't understand that it's all across the board. It's completely and totally pervasive.
Yeah.
So for the rest of my rules, I read rule number 1, and then I went a little bit more in detail about it, how the people in power in Washington, D.C., and in other capitals, they have the power of the law. And these people believe in the law, but that's because they can change the rules and they can navigate through them. They can either change the rules to benefit themselves or they think they're above the law. Rule number 2, guys, for those of you out there, you on Main Street, who can't afford to hire lobbyists and change the laws or to tax shelter assets like some of these rich people who say they don't do it. New York politicians bashing John Paulson, the rich billionaire hedge fund manager, for moving to Puerto Rico to dodge taxes. These are Democratic politicians, and then the next day on the phone, Eric, they got his number somehow. I don't think they're friends with him. They're calling him up, asking him how they can move their assets to Puerto Rico too to not pay taxes.
Yeah.
And they apologized to him over the phone saying, I had to do that song and dance on live TV for my political base to get votes. He was like, I hope you understand. I'm sorry for hurting your reputation and making fun of you and yelling at you and stuff.
Yeah.
Rule number 2 is because of rule number 1, people should not go all in on investing in any one asset class or investing in only one country or company. At least some real diversification is important to protect against known unknowns or unknown unknowns. And Donald Rumsfeld said that. He's not a moron. He's just, a neocon tied to military-industrial complex. I think that's one of the good piece of advice for people is you can't go all in. You can't hold only cash. You can't hold only metal. You can't be all in rental properties and things like that. And you can't be in any one country. And there's many more examples of that. But the people in power, They're going to change the rules to what it benefits them or certain political base or things like that. And this is the dystopian world we live in right now.
And it will not change until basically systems fall apart. And the highest probability outcome of the path in which we are on is that we in fact see that kind of systemic crash where the relationships that have been enshrined under the Bretton Woods system basically fall apart. And it's not likely going to be an overnight, over weekend, even over a month kind of scenario, but it's going to happen. And that kind of my thesis is that if we are to get QE4, there's going to be a period of time at some point where the conventional finance world just second guesses assumptions that they have not been willing to do up until this point. And that looks like 2016 by my word.
Yeah, there's a lot of people, Eric, out there on Wall Street who are Keynesians, who went to Ivy League schools and hedge fund managers and things like that. They think that interest rates will eventually normalize. I don't see a way mathematically where interest rates, maybe they can do a few token interest rate increases, quarter point, maybe one or two, and then we're going to start to see things break, right? Because all the leverage in the system, the yen carry trades and all these, leverage bond trades and the over-the-counter derivatives market, and the Fed's going to panic probably and have to get back to lowering rates. I just don't see any way this works. By raising rates massively. I think we're in the new normal again, where I don't think interest rates can go back to normal levels without the potentially system collapsing.
Yeah, well, every 100 basis points translates to some ungodly number addition to the national debt in the United States. That's somewhere on the order of probably about $500 billion of additional debt for maybe a 150 basis point rise in interest rates. And where we are now, given how much effort has been put to make interest rates super low on a historic basis. 150 basis points higher is no big deal. The United States has typically had 5 to 7% interest rates on the 10-year bond. We're nowhere near that. We're in the 2 and change area. And 150 basis points added on over the course of a 12-month period would be child's play. Something like that can happen very easily. And I think that, in fact, it will happen. Even if the Fed doesn't want that outcome and they fight it with QE4, the bond market vigilantes will finally come out of their coffins and hibernation in caves and demand higher compensation for the risk that is associated with taking on bonds. That is not happening now. The people just are playing this game of the Fed has my back and who cares? And then when you add on top of that quagmire, for seasoning, fears of the deflation crash, you get enough people justified in thinking that the bond market's rational for being where it is. And that won't stay that way.
Because of, these first two rules that we talked about and all these crazy things going on, there's financial oppression. The governments don't want to pay higher interest rates for the most part. They want lower interest rates so they can keep borrowing more and more money at cheaper and cheaper cost to them and keep the game going for as long as possible. Jerry Robinson has talked about this a lot. Follow the Money daily. I pay attention to his work. I haven't read his book yet, although it's on my watch list there on Audible. But his view is that people should add, as many income streams as possible in different businesses. You got to focus, I guess, on making money outside of the stock market because the dividend stocks, the valuations on those, the oil price has been down a lot. There are some MLPs in the midstream that are still doing pretty well, but a lot of these other oil companies have had to slash the dividends, and we haven't seen big dividend cuts from, ExxonMobil or Royal Dutch Shell or Chevron or anything like that yet, but it's a possibility that we could see them. So, people just should focus on creating as many possible income streams and inflation hedges as they can from owning different investments and businesses to protect themselves to survive and thrive whatever is coming in the future, thanks to the myopic stupidity and rent-seeking behavior of parasitical central planners, politicians, bankers, and government bureaucrats, etc.
And it's never been more important to be diversified.
Oh, yeah. Look at all the different rules for businesses that have come out, stuff that get sneaked into bills and things like that. So you think you're set up, you think you're good to go, and then boom, the rules change, and you've put most of your money into one investment, and this is like a cat and mouse game that is almost never going to end. Because, like I said, Eric, the people in power are just, a lot of them, they think that they can control the laws, and they think they're above the laws, and they can hire the best lawyers. So people are going to have to be on their toes more than they ever had to before. In the past, if you made millions of dollars. You could have gone and parked your money pretty safely in the bond market or money markets or things like that, and you could have lived off the interest income, and you would have been fine. But those days are long gone.
And the whole idea about having a risk-free return in a treasury note or treasury bond it's a fantasy now. That's how massive the manipulation has been. It's sad too, because the whole generation has been hosed. I mean, older people traditionally would have a very large percentage of their income, of their assets in bonds, 70, 80% even, and they're earning nothing on it now.
Yeah, and that's why they've gone further up the risk curve. That's why they've went heavily into stocks to bid those up, dividend stocks to bid those up, and the valuations on those are very high if you don't count the share buybacks that they've done and the other financial engineering with the earnings manipulation. So, I mean, there's been a lot of games played to keep the stock market higher than normal levels. Well, I want to move on. Let's talk about some of the other markets that we're seeing here. The oil market now is really crazy. We've gotten to the point now at the oil market where we're seeing enormous amounts of pain from so many of the people who produce oil. And if you listen to CNBC and Bloomberg, you have all these guys saying, oh, oil can easily go down to 20 or 30, and stay there. But they're not. I don't think they've looked at the supply side of the market and seen the production costs and how almost all the oil production, Eric, that has been brought online for decades now, a lot of it's been done with debt, and the costs have risen a lot. So maybe the costs have come down a little bit in the last couple of years, but, I mean, most of the oil projects that have been brought online were at much higher oil prices. So something has to give very soon when, most of OPEC, the unconventional oil producers in deep water, oil sands, a lot of these shale producers, and some of them were hedged for a while, but those hedges are coming off. We're going to have a supply problem here in the near future if the price doesn't go back up.
And within the last 3 days, we've seen last 3 trading days, we've seen this giant move up in oil. And people are ascribing the move to the invasion in Yemen and the discussions amongst OPEC participants about possibly pulling in production levels at some point. But you don't have market moves like this without an underlying condition that speaks to the very facts you just outlined, where there's a certain level, whatever it may be, that the decline, were it to go even further, would just damage the industry to the point of insanity. And too many producers would have to go offline if we were to sustain sub-$40 oil. And that's the backdrop that we see on a fundamental basis. And this sharp move from about 38 last week on an intraday basis, actually went a little bit below 38 on West Texas Intermediate, up to closing today as we record 48.54. I mean, more than a $10 move in oil. That isn't just because of the invasion of Yemen and because Saudi Arabia and other OPEC countries are talking about possibly pulling in some supply. I mean, it's the reality of the fact that at some point in the 30s and below that so much damage is done to the industry that it would, by definition, create supply destruction and higher prices thereafter. So the traders were looking for the catalyst by which to justify jumping back in, and that's what we got last week.
Yeah, and we had, that obviously when the oil price goes up that high, there's going to be a short squeeze. So there was too many people who saw the trend, who saw the chart, thought it was really easy money shorting oil. Oh, we're going down to 30. Oh, we're going down to 20. There was lots of people in the mainstream who just drew a trend line on the oil chart and said, it's guaranteed we go to 20. I was talking with Robert Rapier, who I interviewed a couple weeks ago on Facebook about that, and he was telling me he was getting a lot of backlash from regular oil people, mainstream people who were looking at the oil market and hadn't paid a lot of attention to it. They hadn't been in the market for 20 or 30 years working in the oil industry like him. And Robert's like, look, basically, if we go to 20, there's going to be some oil production still, but most of it's going to have to get shut down, or they're going to have to tap the bond market or sell shares, and there's not a lot of capital available. So it was going to be a huge bust, worse than 1986 then if we went that low, because a lot of the industry, the only way it's grown is with debt. For the most part. I mean, they sold shares, but, most of the shale oil production is based off of debt. It was cheap capital from the Federal Reserve and the banks. The banks, for the shale players, Eric, I don't think they've written off any of the bad loans yet. So we haven't seen a lot of bankruptcies yet in oil. And, if the oil price still, even at 48 oil, that's not a good price. It's not a good price for the majority of companies out there. I mean, OPEC can survive it longer than other people because they're lower cost producers, except for Venezuela. But, the Middle Eastern ones are pretty low cost producers. They can survive that for longer than other people. But, I mean, you look at the market, and at these low oil prices, you start to see demand out of other countries start to pick up. The International Energy Agency is saying that we're going to go to 95 million barrels per day oil consumption due to cheap oil prices and demand for cars and things like that. So they're still expecting that big bump because, low prices do stimulate demand. It's just not a free market anywhere there. When you have a large cartel like OPEC, and there was so many people in the mainstream saying, OPEC, the Saudis, they don't have any power anymore. Well, they still have some power because they almost, took out like most of their competition in the last 6 or 8 months.
Yeah.
Okay, well, I want to move on now to gold and silver. There's an interesting article that's going around in the gold and silver community that I found on Facebook that a friend shared with me. It's called Gold Miners $1,200 Cost Fallacy by Adam Hamilton. Basically, he says he has 15 years of experience buying and selling and recommending mining stocks of different types of commodities. And he's been saying that it's a fallacy that the miners' production costs were $1,200 and that, let's see here, that wasn't the reason why gold should go back up and things like that. We'll put a link in there. And then one of the main parts of his article is he has all-in sustaining cost numbers for Q2 of 2015 here for most of the larger gold miners. Now, one of the things about the article, the numbers are actually correct about the all-in sustaining costs for 2015, but one of the misleading things, and I've been paying attention heavily to mining stocks since 2008, and one of the main things that this article doesn't have is that these all-in sustaining costs, they are lower than the original production costs were a number of years ago, but it took most of these primary gold and silver miners, Eric, 3-4 years since 2011. They've been reactive. They've been really behind the curve in terms of cost cutting. So, when gold and silver the paper prices were manipulated, and when the correction did start, and when the bear market did start, and the support levels were blown out, even in late 2011, 2012, a lot of these miners, some of them were still trying to bring on higher cost mines, expecting the prices to bounce back. So we have a situation. Yeah. So we have a situation here where, you have an article and you show the costs for one quarter, and yes, the miners have finally done a good job cutting costs. But Eric, and you can tell me if you think I'm wrong about this, but it seems like every time the gold and silver miners work really hard to cut costs, another 10, 20% or something, and they've cut, I think, 30 or 40% of their production costs since 2011, which is good, but it's taken them, like I said, 4 years. They've lost a lot of money all the way down. And this article doesn't talk about how basically every time the miners cut mass amounts of costs, the paper price just drops even lower below the costs that they've cut.
It takes time to lower costs as well, too. So, this transition that we've seen since 2011 makes sense, and then the speed at which the declines have been happening, particularly, since the 2013 drive-by shooting in April, are overwhelming the industry. And if we continue to see declines in the price of gold, that it will, in fact, curtail forward supply significantly. I mean, 20% reduction in forward supply 2 years out is doable. That's a very large shift within the market that would, in fact, demand further price increases thereafter. So the cartel that has been manipulating gold in service of maintaining the financial markets and the way in which all the other manipulation that we spoke of, in fact, has been able to be done, would not have been able to be orchestrated were it not for all of the aggressive manipulation in the price of gold. So people following the trends, following the thesis of Wall Street Journal, all gold is just a pet rock. I mean, the belittlement of gold as a safe haven. Just yesterday, Bloomberg was launching out a story saying, well, why is it that gold is no longer performing as a safe haven asset? Investors want to know. I'm paraphrasing the headline. We are now in a place where we just can't go that much lower without having longer-term damage to the industry on a very large magnitude. So, regardless of where Adam Hamilton is drawing the line, the reality is such that that's where we stand. I mean,
Well, he's right about looking at this point in time that maybe the production cost numbers are no longer 1,200.
Yeah.
And, when I look at in the chart that he's providing, he's pulled the cost numbers for a lot of the miners, so that's not easy work. So he did do a good job on that, but he's not showing the whole picture that you have to look back from 2011 to now and show how long it took them to cut the cost.
Right.
So let me provide some examples there. Pan American Silver, who is one of the largest primary silver producers, now I think their all-in sustaining cost they claim is like $14.50. But 2 years ago, I think in 2013, when I was looking at them, their costs, Eric, were still around 25.
Yeah, exactly.
So this took them, they were hemorrhaging cash. So they had big write-downs on bad acquisitions. They had higher cost mines. It didn't take them, 2 months or 5 months or 6 months to cut massive amounts of costs, to cut costs 30, 40%. It took them years. And I don't think most people who look at these markets understand how difficult it is, like you said, to cut costs at a mine. This is not something that can be done in a couple weeks or a month.
Yeah.
Not unless like the company's trying to stave off bankruptcy, and even then, it can't be done. The company's probably going to have to agree to an emergency panic buyout, like you had with a company like Revit Minerals. Revit Minerals was a small little junior, and they had a producing mine named Troy Mine, which was a copper-silver mine, a smaller one, I think, up in Montana, and they had this very large undeveloped mine called the Rock Creek Mine. It's one of the 5 or 7 largest undeveloped silver mines in the world, and their producing mine had problems, cave-ins, and it shut down. And I think at one point, Eric, in 2011 or 12, their market cap was well over $100 million. It might have been over $200 million, and they panicked and sold out to Hecla Mining in the last couple months for all-stock deal, and guess what they sold out for?
Tell us. I wasn't following this story.
$19 million.
Ouch.
So they went from way over $100 million, and they sold out in a panic deal for 19. They're better to have something than nothing, and at least you have a shot. Then if the silver price goes back up, at least maybe you can get back a little bit of your capital. But that's almost like a total completely collapse. It's not technically bankruptcy, but I mean these are assets where they were worth a lot more than that. Obviously, they would have had to sell more shares to build that other mine, but I mean the other mine, when the silver is needed, that thing's going to be making a lot of money at some point.
Yeah.
So we're in a situation of dire consequences for the miners, where they finally have cut costs, but if the paper price goes lower, most of the mines that were brought online since 2009, their feasibility studies were way higher than the metals prices. So I've listened to other mining experts, like actual geologists and people who have run mining companies like Keith Barron. So I'm not just shooting off my hip. And Keith Barron has been saying since 2011 and 12, when the price started correct, he was going visiting mining companies and mines, and he was seeing they were high-grading mines, which are not supposed to be doing according to the mining plan. And these all-in sustaining cost numbers, I don't even think they include any exploration costs, so replacing any of the reserves at the mine. So this is a situation here where the industry doesn't have capital available. It's not really replacing any of its reserves, and yet we have people saying, oh, the miners can survive these prices.
Right.
Maybe they can tread water for a little bit of time, but I don't think they can survive the prices.
That's actually a really great point you mentioned, because not a lot of people think about the ongoing exploration costs, say 3 years out and further in time. That's not really in the business plan, not modeling the analysts, to BMO Capital, never mind an average investor is thinking about when it comes to the sustainability of the industry. So, it's something that people really do need to think about when it comes to defining what is all in cash costs, because it's a distortion.
The cash costs were a very misleading indicator. The miners have gotten better at reporting what the real costs are with the all-in sustaining costs. But they still don't include the all-in sustaining costs, some of the other extra costs. I don't remember if the all-in sustaining costs include selling general and administrative expenses, the SG&A still, or the exploration costs. I'm pretty sure they don't. Someone could check that for sure. But one thing I would say though is that if you built a mine after 2009 and you needed $25 or $30 an ounce silver, and you got the money and the shares, the debt and the shares, and maybe a royalty or stream to build the mine, your mining plan was built, that was signed off in the feasibility study from the engineering and all the other stuff in the geophysics and the metallurgy. It was signed off on, mining this amount of high-grade stuff, this amount of, not as high-grade stuff, and that's what keeps the mine done. And what the miners have done is for the last 4 or 5 years, they've switched from mining the lower grade stuff at lower margins. When the prices were higher, they were still making good money on that. They've switched to only high grading a lot of the mine stuff, and that's going to destroy the mining plan at the mine. So these mines, maybe in the short term, they've been able to cut the costs on them, but in the long term, these are going to be higher cost mines because all the high grade material now is being mined just to survive.
Yeah, that's right. And a very large number of miners have been doing just that. The high grade.
Yeah, I completely agree. The industry, the contacts I speak to, and I know the Sandstorm Gold guys up in Vancouver. I know, Sprott people in Toronto. I speak with other different people in Vancouver and Toronto. And there's really not a lot of capital left for the miners. Maybe if you're a pretty efficient producer, if you're like maybe a First Majestic Silver, there's the investment bankers are going to call willing to sell you some shares and some debt, although I think it's dangerous to take on any debt at these levels now because we don't know if the paper price is going to be manipulated lower. So I think debt's really dangerous. And we've seen what's happened in Burack Gold where, Burack took on a whole bunch of debt because it was cheaper at the time to grow their company and try to bring on all these expensive mines. And now they're selling, these assets for pennies. Royal Gold, who's a royalty and streaming company, who these guys are in the driver's seats because they can grow without taking on debt. They have free cash flow, and they have a lot of cash on the balance sheet. Royal Gold just went in and they bought a large gold stream on one of Burack Gold's lowest cost gold mines in the Dominican Republic for a very cheap price. So I mean, we're gonna see these types of deals here where the miners can't raise the capital they need, and someone who has capital is going to come in and take advantage of them.
And it's ripe for investment as well. I mean, on a risk-reward basis, the mining sector is so bombed out that if you're looking at a 1-year time frame or longer out in time, it's a great place to put some capital. Obviously, you need to be careful and pick high-quality management teams and companies that have good properties and political jurisdictions that are more safe than not. All those considerations are factors. And even in our world where we have the risk of the MF Global scenario where you can find your brokerage firm it's going under because of whatever crazy stuff that they may be involved with derivative trades or whatever, and they blow up their book. You can take possession of shares directly and not leave them in street name in your brokerage account. So, a lot of people in the precious metals community, in particular the stacker community, look at mining shares and it's like, showing a vampire, a garlic, they recoil from it. But there is a place for having, like we talked about before, the diversification value and benefits thereof that mining shares give to an overall portfolio. And then now is a wonderful time to actually scour the sector and look for good companies to buy.
Yeah, and one of the other things besides geopolitical diversification and management is debt. You have to be very careful with debt. How much operating cash flow per year does the company have? How much cash on the balance sheet does the company have? If the company has $80 million in debt, and a lot of it's due in the next year or two, and they only have $20 million in cash, and they have on their balance sheet, and they have very little operating cash flow, even if they have the best asset in the world, they're going to have to either sell the asset itself for pennies, or they're going to have to sell the company for pennies to survive. That's not a solvent company in this environment because there's not a lot of capital available.
Yeah.
So it's a very speculative investment. You're gambling then that the gold and silver price can go high enough for the company to raise the money to survive until the price goes higher then for that type of thing. So the companies right now are the ones that can either still make money at these prices, don't have a lot of debt, or they can grow without debt. Now, there's not a lot of mining companies, Eric, because how expensive a mine is, who can bring a mine online without debt and grow without debt and stuff like that. So that's why I really like the royalty and streaming companies, like the Franco-Nevadas, the Royal Golds, the Silver Wheatons, the Sandstorm Golds. Some of these companies in the short term, Silver Wheaton thought silver prices had bottomed in 2013, and along with gold prices, and they did some deals and took on some debt. They were early, but in the long, they have a lot of cash flow. So they're paying off the debt. But in the long term, this business model is going to win as long as the management team doesn't do too many bad deals in a row and take on too much debt. Okay, well, one other thing about the gold and silver market I think is just really ironic, Eric, and this is something I noticed on CNBC and Bloomberg when I watched it when the stock market was having a correction, is when gold and silver paper prices drop, they say it's all on fundamentals. Oh, people don't want gold. There is no inflation. The pet rock argument. You know the drill. But when regular stocks drop, it's manipulated. The technicals are manipulated. It's HFT algos. It's just a healthy correction.
It's China. It's all their fault.
Oh yeah. Blame it on everyone else. I mean, the CNBC and Bloomberg people, like they're put in place. Their paid sponsors are the mutual funds and the investment banks and things like that. So their job is to sell regular stocks and bonds, and get you to buy mutual funds and maybe watch CNBC and check your account once a day, and the market's going up, and the economy's doing well, and all these other things. I mean, with the oil market in the peril it's in, almost all the jobs that have been created, all the high-paying full-time jobs that have been created since 2008 were all shale oil jobs.
Yeah.
And if the oil price stays low, those are going to go away. So where are the jobs? Where's the economic growth?
Yeah, and that's just using the government statistics on jobs. I mean, on a net basis since 2008, we've seen the destruction of 15 million jobs. And people are celebrating about a 5 and change unemployment stat as if it's real. I mean, it's just farcical the degree to which our numbers are being managed.
Oh yeah, that's part of rule number one. The economic data is one of the biggest forms of propaganda right now. Besides the stuff the mainstream media says, the economic data is enormous. I read this book about Google, and one of the co-founders of Google, Sergey Brin, his family escaped from the Soviet Union, and his father was a economist at the Soviet Union, in their planning department, and he was in charge, along with a bunch of other PhD economists, of coming up with new ways to come out with economic formulas for there is no inflation in the Soviet Union, and that the standard of living of the average Soviet family is higher than the average American family. They were in charge of that data propaganda. I mean, no one in the Soviet Union believed it, but they were, paid and forced to continue to come out with new formulas and stuff. And the sad part is, we have that now going on in all these different countries, but no one questions the data. They want to believe in the system. But we do have, in the U.S., we have people, all the China data is manipulated. Well, Eric, where do you think all the PhD Keynesian economists in China, where do you think they learned it from?
They got their tips for manipulation from their Ivy League experience.
Yeah, or on Wall Street, or at their Keynesian universities here in the United States, or in London, at London universities,
right.
all the same types of stuff. So that when you have a regular Keynesian around, a guy who's made a lot of money in regular business, or went to a fancy business school, or he, reads Wall Street Journal or CNBC and Bloomberg all the time, these are the questions I bring up, well, you agree that China's manipulating their data, but where do you think they learned how to do it? I like, bringing that up to people if they tell me they're in business and stuff like that, and, what I do. And then the other funny thing is I ask them is, well, do you pay the bills at your household? And then, some of them say yes, and I was like, well, are your bills going up? And are your property taxes going up, your grocery bill and this and that? And they tell me yes, and then they try to make excuses for, that's not inflation. Oh, it's anecdotal. I was like, well, how come then on our podcast, I asked people if their bills are going up, and it's not anecdotal if, we have thousands of people all over the country in different states and things like that telling me that their bills are going up in, property taxes and food and all these different things.
Yeah. And the ways in which the various government statistical manipulations have taken place are all very well documented. It's not like some kind of wacky conspiracy theory. It's documented. The process and plans that were developed under the Boskin Commission with Alan Greenspan represent probably 2/3 or so of the distortions in the CPI index, for example, and all the things that they advocated for substitution, where if steak is going up too much in price, you swap it for hamburger. It no longer, the CPI represents a cost of living, standard of living, but rather just this kind of bastardized moving target that they can move around, and hedonics and substitution and seasonality changes and on and on and on. I mean, the geometric weighting serving as kind of a break in terms of fast moves in the data itself. The thing is a creature. It's like a Frankenstein. All of this is public information, and you get someone like John Williams over at Shadow Government Statistics talking about it to the point where people who are curious, they can learn about it, but beyond his work, it's really not mainstream discussion. Or Peter Schiff trying to pound the table on CNBC or Bloomberg whenever he's able to get on when they let him on. And other times they frankly don't invite him on shows that he's disclosed about. How the producers would say, we really don't want to talk about this kind of stuff. So,
or it's like his Daily Show appearance where he went there for 6 hours of recorded video, right? And then they edited everything out for 2 minutes, and just to make it say that he said something racist,
right,
when he was talking about all these things about the economy and stuff like that. I mean, obviously they weren't going to let him on there speak for 6 hours, but maybe for 10 or 20 minutes so he could get his views expressed efficiently, but that's not the host job he got.
The framing in the media is a refined science at this stage, and the powers that be can spin anything.
Oh, yeah. We're going to have Greg Hunter on in the near future on a Welcome to Dystopia podcast, the USA Watchdog. He's a former journalist working in the mainstream media with CNN and other places. So we're going to get his take on, how doctored the news is and all this other stuff in the future as well. Hopefully I can get him booked in the next few weeks. I was supposed to have him on soon, but, schedule conflicts. In wrapping up the show here, Eric, we have our Scumbag of the Week segment. We have some really interesting stuff. Okay, so we have Jared Fogle, who's the oh my God. This is the Subway pitch guy. I guess for those of you not familiar, he's on the TV commercials all the time. I think a while ago he lost like over 150 pounds, I think, eating Subway sandwiches and walking. And, he seemed like a pretty regular guy. He seemed pretty boring actually on the TV commercials, but, I guess all the stuff that's been coming out about him, he's into kiddie porn, and he paid a 16-year-old girl, or at least one 16-year-old girl, for sex, and he was bragging about it to friends, and there's documentation on it on his text messages, and he told his friends about it, bragging about it, and he's involved in child porn and other crazy stuff. So I mean, this is going to cause a lot of collateral damage with his family. He was married, and I think he had 2 kids. His kids are going to have pretty screwed up lives. I'm really sorry for all that collateral stuff, but he's definitely Scumbag of the Week material for the nominee, maybe even Scumbag of the Year. He's pretty bad.
Yeah, a great anecdotal example of how not to run your life. In thinking about the various candidates on a bigger macro scale, I think we could fairly throw in Petro Poroshenko, who's the president of the Ukraine. The Ukrainian parliament has been going through the process of amending their constitution, and in the Minsk II agreements a few months back when they did the ceasefire, and Angela Merkel and France and various European parties basically turned their back on the United States and NATO's objective of trying to escalate in favor of fighting in the east and the separatists in the east in Ukraine. The deal was that the Constitution was going to be amended to have these separatist territories have autonomy, and they have voted and approved the amendments to the Constitution, and it's not affording any degree of autonomy at all. And so, the media in the West always paints the picture of the Russian-backed separatists or even Russian invasion forces directly being responsible for the falling apart of the peace agreement that they came to a couple months back. But in reality, here we are. It's not being reported in the Western media, but Petro Poroshenko and his parliamentarian lackeys have basically flushed the Minsk agreement down the toilet. And the ramifications of this is that at some stage we're going to see an escalation, most likely, and maybe even boots on the ground, NATO boots. So, this is the kind of thing that is ratcheting up geopolitical tensions that is flying under the radar, and it's good to toss this out here because, frankly, most people in the West wouldn't even know that story because it's not being reported anywhere.
Well, the neocons in D.C. have wanted Russia and Putin have been the new bad guy for a while, whether that's on House of Cards with Putin lookalike being the newest season of House of Cards with Putin lookalike being like the new bad guy, or so many of the other examples of that. But it's no surprise because the mainstream media has been just pretty much relentless on making Putin look bad. So I mean, I guess the bad guy has switched. The bad guy switches, it's all this guy's fault. Oh, it's Russian hackers. Have you noticed, it was either Chinese hackers or Russian hackers or, someone breaking into this corporation cybersecurity hack or this with the Pentagon. Oh, I mean, I don't know if we'll ever find out the truth who actually did the hacks or not, but it always seems to get blamed on the flavor of the month or flavor of the year of whoever the new bad guy is
Well,
in the U.S. They did.
That Sony hack example, we actually did find out that it was a disgruntled employee who basically was, doing the hack. It wasn't the North Koreans. So, it's sometime with the passage of time, we get the truth. It outs itself.
Yeah, I agree, but that's becoming less and less apparent. Although we do have the new internet and other bloggers and investigative journalists like yourself looking for the truth online. But it's becoming tougher and tougher to figure out what the truth really is anymore because, the spin is just, it's relentless. Okay, well, the last story I have for Scumbag of the Week nominee, this is feds who stole $167,000 in cash from innocent man in civil forfeiture seizure, refusing to return it despite judge's order. This is a story by Cassandra Fairbanks, who I think her Twitter handle is Cassandra Rules, but she's a investigative journalist who goes around the United States looking for, police brutality and police state stories. So the story is in perhaps one of the most offensive cases of civil forfeiture. Federal prosecutors are fighting to keep $167,000 in cash seized during a traffic stop despite no crime being committed and a judge ordering it to be returned in June. The person was on a trip. Strawn Gorman was on a cross-country trip to California in his motorhome when he was pulled over by a Nevada state trooper for allegedly driving too slow on the interstate. And they don't want to hand the money back, even though they're being ordered to. No drugs were found in his motorhome, but they found the cash stashed. So I guess they forfeited it. Eric, what do you think about all this stuff? I mean, it sounds like, the judge is telling them they have to turn the money back. Do you think they spent the money already? Why do you think they're not returning the money?
I don't know what the details are as far as, whether or not they spent it or what have you, but it's not surprising that they would try to hold on to it. Civil asset forfeiture has become a huge problem in the United States where, many a police department, and it's not just anecdotal, literally build their budget expectations on how much money they're going to get from drug raids and trivial stops like the one that you're describing here where there's no crime being committed, but if you travel with an excess amount of cash, you're assumed to be a criminal, money laundering or drug dealer or what have you. And there's police departments literally that factor into their budgets an X plug for civil asset forfeiture monies that they pull in. There's this, it's creating a distortion within the law enforcement community, and it's a big problem. And so much so that I think even Congress at one point was kicking around the idea about a bill of reforming the way in which police departments would have the latitude to deal with executing confiscation of someone's assets. But we're a long way away from ever seeing some kind of reform nationally, and the problem keeps getting worse.
Oh yeah, I agree. Government's just too greedy. They're making a lot of money off of it. That's less money they have to secure from other sources. And this is just a symptom then of a totalitarian police state growing and growing and growing. Whether it's SWAT teams that are basically dressed up like military paratroopers or going to people's houses who are minor criminals in tanks and SWAT team gear and stuff like that, or bail-ins. I mean, these are all large evidence and symptoms of a growing police state and the desire of the people in power to, basically say, you don't have the freedom to liquidate your checking account and, drive it across state lines now. If we catch you with it, we're going to assume you're a criminal. You're guilty until proven innocent. And
some people may hear the word police state when you mention it in that context and think you're prone to hyperbole. But, where do you draw the line? Yeah, okay, it's maybe only 0.5% of people that have this run-in with the law or any kind of other example. But the point is that it's a systemic and increasing problem, and it's accelerating too in terms of the abuses of police forces all around the country. And the militarization of the police is something that people should be very concerned about, because were we to have a financial crash and riots in the streets and devolution and the great stuff that all comes with a dystopic kind of burst of social unrest and erosion of the social compact, which is highly probable in the months and years ahead, what you think the police are going to just be, standing idly by with all of their new toys? Heck no. It's going to be a mess.
Definitely not, Eric, especially when we have the prison industrial complex, when we have publicly traded stocks, and they're looking for new ways to put people in jail for different crimes. I mean, most of the people in jail, right, are nonviolent criminals. They're in there for very, very minor drug offenses, like a small little possession of marijuana now. That's why, they search your pockets looking for a little bit. Even if you're busting on a traffic stop. I read an article from Jeffrey Tucker, who was arrested for a very routine traffic stop. I think he had an unpaid parking ticket, and he had a voucher that his license was renewed because he had forgotten to pay a parking ticket and was temporarily suspended. And then he went down and got the right voucher, and then the cops ran his license plate number and stuff and saw it hadn't been changed over in the computer system, and he went to jail temporarily, I think, for a night. And, they were checking his pockets looking for even little traces of marijuana so they could add extra time onto a sentence and then start seizing some of his assets and things like that.
Yeah. It's routine to go on those fishing trips.
Well, it's just really sad. I mean, the incentive structure is screwed up. I mean, this is not a free market. This is not capitalism here. This is what happens when big government gets too big. The war on drugs. I mean, it's failed. It's been a total fail unless the goal was for the government to get a cut of the drug money.
And also, the 70s, in the 1970s when Richard Nixon launched the war on drugs, I mean, it was a foregone conclusion that part of the motivation was to erode away civil liberties. And here we are now with the civil asset forfeiture problem and the drug state and prison system and on and on. I mean, the incentive system, as you say, is truly screwed up. It is creating this, endless rise of the police state.
Fortunately, it's only going to get worse before it gets better. Welcome to Dystopia. You guys out there need to be careful. I mean, you guys are pretty much everyone there's a book out about this is committing 3 felonies a day. So you need to be very careful and be polite to the police officer and, don't be like, there's like libertarian videos out there like, are you going to detain me? Just be very polite to them. And, maybe they'll let you off with a warning or a ticket or something like that. And that's the best you can do in the system. You just got to be very careful and hope that, you don't end up in jail for doing something really minor.
Yeah.
Okay, well, that's the end of our show today. So, I think going forward, guys, you need to buckle up your seatbelts. We're going to see a lot more volatility in markets, in the currency markets, maybe not in the bond market necessarily yet. I don't know if it's going there because, like Eric said, a lot of money is being printed in currency swaps. I guess that's probably the new quantitative easing is it's more covert now, is we have these currency swaps now instead of quantitative easing because too many people know what bailouts and quantitative easing are, so they've switched now to the currency swaps because they can hide those easier.
Yeah, in terms of ongoing QE as well, they still roll over the interest and the maturation monies that come from bonds that mature in the Fed balance sheet, and they just recycle it. And part of what happened last week was probably from funds that came from that very process where the Fed had excess reserves they put on the side from QE3 to have his powder to use to manage the markets when they want to. So,
that's a great point, Eric, because QE technically ended, but yet we have evidence the Fed's balance sheet is over $4.4 trillion.
Yeah, I mean they're not reducing the balance sheet. I mean that's just public information there. And then they do all the other stuff underneath the surface, whether it's buying derivative positions and managing S&P 500 futures or purchasing bonds from the Caribbean money centers or Belgium or whatever. I mean, there's a lot of under the surface activity that's still going on that is, for all intent and purposes, QE by any other name.
Yeah, and we had China dump this massive amounts of treasuries, right, to try to stabilize their RMB after the devaluation because it didn't go as planned. And yet the dumping of all those treasuries, it didn't affect the interest rates or the bond market or anything. So obviously that's red flags there that it didn't affect anything because this was a massive dump.
Yeah, and part of it may have been absorbed with the largesse that came from doing a currency swap with the Bank of Japan. That could easily account for the extra absorption demand in the face of $100 billion being dumped in a 2-week window. I mean, that is a heck have a lot of treasuries being dumped into the marketplace.
Yeah, I agree, but and yet, this doesn't, you'd think in a free market, right, with that much dumping of markets, this would cause enormous disturbances to interest rates, and the bond market didn't do anything.
Yeah.
So, we don't have the people say, oh, we have free market. We don't have free markets. We have manipulated and managed markets. Maybe in technology there's some free markets. Maybe there's small little pockets of them. Maybe on Main Street for the common guy out there, he has to run his business like it's a free market, and he has to be very careful about taking on too much debt and risking bankruptcy and things like that. But the people at the top, the people running governments and Wall Street and things like that, they don't have to worry about that because they have almost unlimited resources with these digital currencies to manipulate markets at will.
Yeah. Well, at some point that is going to end, and I think that if we do get into QE4, that halfway through it, the market participants that at least have some intelligence left and haven't been propagandized to the point of oblivion will look around and say, geez, we really need some real compensation for real risk, and this fantasy world of risk not existing is just that, a fantasy world.
Everything's a fantasy world now, Eric. If you listen to the CNBC people, you're like, oh, the stocks are just taking a healthy correction and we're going to get back into the bull market. It's going to climb a wall of worry and the stock market's going to double. There's some people out there saying the stock market's still going to go up 50%.
Right.
There's regular people in the mainstream saying, oh, the oil market will be just fine at $20 oil or $30 oil. There's all the producers aren't going to go bankrupt and all this stuff. There's a lot of people living with their head in the clouds. I think they've gotten complacent. They've gotten lazy. They've gotten fat and happy and rich off the status quo, and I don't think they really understand what's going on from talking to most of them.
So true.
I've tried to get regular Wall Street hedge fund managers, a lot of them, on for Wall Street for Main Street podcasts, and some of them don't email me back. Some of them give excuses or cancel at the last minute. So I don't know if it's because they research my work and see that I do talk about gold. I don't know why. Some of them are polite about trying to reschedule or can't do an interview now or things like that. So just trying to get their opinion on if they think stock market's overvalued and things like that, and they don't want to do it. But we have almost 1 million views now, so we're not nobodies anymore.
Yeah, and then after the crash, people will be calling up you and saying, I was predicting this was going to happen, and I want you to interview them.
I think if you're an options trader, with the volatility I see coming that has started to come back in the market, being able to understand how options work, and some people are like, oh, I wouldn't trade stocks or anything like that, and obviously you shouldn't put all your money into it, but if you know how to trade options with this type of volatility up and down, there's going to be a lot of money to make to protect yourself, and maybe if you do make profits trading options, you can go buy more gold and silver with the profits. You don't have to keep all your money in your stock account if you do that. That's just something to consider for an additional source of income because of the volatility I do see coming back. Okay, great. Well, I just want to thank everyone for listening to this. This was episode number 7, like I said, and we're going to try to get on Greg Hunter and other interesting guests for future episodes of Welcome to Dystopia, and we'll keep it kind of sarcastic and funny with other scumbags, so like Jared Fogle, who is an enormous scumbag, and, it's always fun to find funny government stories where they've done really stupid stuff. I think we could do a whole show just on that going forward in the future.